Ever wondered how insurance limits work and how they can protect your assets? Well, let's dive right into it. Insurance limits are essentially the maximum amount an insurance company will pay for a covered loss. Think of it as the safety net that catches you when life decides to throw curveballs. They're not just numbers on a page, but crucial components of a robust financial plan. They play a pivotal role in safeguarding your assets. Understanding insurance limits is vital in ensuring you're adequately protected. So, what exactly are insurance limits? Well, let's picture them as invisible fences built around your policy, determining how far your coverage extends. There are three main types of insurance limits we'll explore today: the per-occurrence limit, the aggregate limit, and sub-limits. Think of the per-occurrence limit as the maximum amount an insurer is willing to cough up for a single mishap. Say you have a car accident, and the repair costs come up to a hefty sum. Your insurance company will only foot the bill up to the per-occurrence limit. Anything beyond that, and you'll have to dip into your own pocket. Now, let's move on to the aggregate limit. This is the total amount your insurance company is willing to pay over the length of your policy term. If you think of insurance as a jar of coins, the aggregate limit is the total number of coins in the jar. Once you've used them all up, you're on your own. Lastly, we have sub-limits. These are specific caps set for certain types of claims. Imagine you have a homeowner's policy with coverage for both the structure of your home and your personal belongings. The sub-limit would be the maximum amount your insurer would pay for a specific category, like your personal belongings. Knowing these types of limits can help you understand how much coverage you have and what you might have to pay out of pocket. Knowledge is power, especially when it comes to protecting your assets. Now, how exactly do these insurance limits protect your assets? Well, insurance limits play a pivotal role in asset protection. Think of insurance as a financial safety net. It's there to catch you when unexpected losses occur. But like any net, it has a capacity. That's where insurance limits come in. These limits represent the maximum amount your insurance policy will pay out for a covered loss. This prevents you from having to bear the full brunt of a loss, thereby protecting your assets. Imagine a catastrophe, say a house fire or a car accident, where the cost of recovery could be staggering. Your insurance steps in, covering these costs up to your policy's limit, preserving your savings and other assets from being wiped out. However, it's essential to understand that having insufficient insurance limits could leave you exposed. If a loss exceeds your policy limit, you'd be responsible for the excess amount. This could lead to significant out-of-pocket expenses and potentially put your assets at risk. So it's like walking a tightrope. On one hand, you don't want to overinsure and waste money on unnecessarily high premiums. On the other hand, underinsuring could leave you vulnerable. Therefore, choosing the right insurance limits is crucial in safeguarding your assets. It's about finding that sweet spot where you have ample coverage to protect your assets without overpaying for coverage you don't need. In conclusion, understanding your insurance limits is more than just knowing your policy's maximum payout. It's about ensuring you and your assets are sufficiently protected. We've covered the different types of insurance limits and their role in asset protection. Take some time to review your insurance policies. Are your limits high enough to cover potential losses? Remember, the right insurance limits can make all the difference in protecting what matters most to you. If you found this video helpful, like, share, and subscribe. Thank you.